Hello, everybody, and welcome to our Tradition Mortgage podcast. Today we will have a quick market update, and then we will welcome in a special guest to talk about new construction loans. New construction can include a lot of things, and so we'll certainly break all that down for you. But first of all, I'd like to welcome Erik Hendrikson, president of Tradition Mortgage, who's been a very busy man this past year. Erik, thanks for joining us, and things are moving and changing in the markets. Can you give us a brief synopsis of what's been happening lately?
Sure, thanks, Mike. Yeah, really, we really enjoyed a very long stretch of very stable rates in 2020, and that in the mortgage industry is an anomaly. And in our business, the longer things stay flat, it's kind of like a coiled spring that gets tighter and tighter. So when there is a movement, it really is very extreme, and these past couple of weeks were no exception to that. And we saw, loan rates move in many cases for most products over 50 basis points, so over 0.5%. So I mean that is a big movement. That's the bad news. The good news is we're coming from an incredibly low position. So even after accounting for that 50 basis point move, we're still at really historically low rates. So it definitely puts a damper on the refinancing because a lot of people were already sitting on very low interest rates. But certainly from a standpoint of purchasing a new home, still great attractive rates.
And we will, of course, discuss how that affects the other parts of the market, especially what we're going to talk about today, and that is the new construction areas. And to do that with us is we're welcoming in Joe Bauer. He's Executive Vice President of Tradition Capital Bank, and he leads Edina and the new construction area for that. And Joe, welcome. And this is, I know that new construction was fast and furious for a long time. How is it right now? How are things, given the market that Erik just talked about, how are things in the new construction area?
Yeah, thanks, Mike. Well, in the new construction area, it continues to be very busy. We're having the bank is seeing a lot of activity in new construction, and what we're seeing is that it's really a dovetail of kind of what's happening in housing with really low inventories. People are wanting to move, but it's supply and demand. They're sick of putting in multiple offers on houses and striking out because there's just not a lot of inventory. So then they consider, okay, what's my next option if there's no existing homes? Then they look at building. And then I think also with the pandemic, it's really changed the way and the priority that people have in their houses. I think that having a space where you can work and do things from home is becoming more attractive, and building is one way to create a space that works for you and your family. And I think that even as we see people going back to work, I think there's going to be a hybrid of people working from home some days and going into the office some days. And I think having a home that's designed to be able to do that for you is very key, and people are prioritizing that. And so that's driving a lot of new construction activity then as well. And the builders are trying to accommodate those things for people versus being unable to find that in an existing home.
And Erik, I want to talk to you a little bit about the philosophy about getting a new construction loan, because it isn't simply ground up necessarily, right? I mean, you can get a new construction loan for other things, and there's other versions of it, if you want to call it that. It's not just, let's break ground and build a brand new home. There's other ways and other reasons to get a new construction loan.
Yeah, I mean, really, when you talk about construction financing, I mean, you have a lot of people that are doing a significant remodel, which in essence is using a construction loan to accomplish that. So like Joe had talked about, if you really are searching for a new home and you can't find one, going out to a vacant lot and building from the ground up is kind of the construction loan that a lot of people think about. But also you do have people that are looking in existing neighborhoods, and they might tear down a property and rebuild, or they might take a property, not necessarily go right down to the foundation. They might put a second story on or push out the back, and those types of options are available too. So you're seeing a little bit of everything. And we're fortunate that we do have the expertise here at Tradition and inside of Tradition Capital Bank to be able to accommodate those different types of loan requests. And, with the appreciation of properties throughout the Twin Cities, people are able to finance a good portion of those major remodels, so they're not necessarily having to come into the transaction with a tremendous amount of cash, because how the valuation of these homes works is we get to take into account the completed finished product, the extra square footage, the bedrooms and bathrooms, and the comparables that are used for the appraisal are, again, based on that finished product, not the starting product. So again, people are pretty surprised oftentimes when that valuation comes back that it is supportive of being able to finance more than they thought. And then again, with low interest rates, they're able to kind of, I call it, go long, borrow more money, and still keep their payment in an area that fits in their budget.
Joe, Tradition Capital Bank obviously is very experienced in this field. What has allowed you guys to become experts in here? What obviously you've been involved yourself in this considerably. So tell us what it is about Tradition Capital Bank that has given them kind of that leg up and on the competition to really dive into this market and be leaders in this market.
Yeah, I think there's a number of things. I think just kind of the background of some of the people who started the bank. They're developers and then are investors in the bank. We have home builders who are invested in the bank. So it's really kind of ingrained in not only just from the people who started the bank, but then the people who are involved in the bank. It's really kind of ingrained in their background. And so there's a lot of comfort level with the process and the market for construction. So that's really kind of the start of it. And then we've worked with a number of different builders, and so we're very familiar with their processes. And so if we're working with a builder or a consumer, we're very familiar with, hey, how do you facilitate the construction process, working with the consumer and the builder to make sure the draw process goes smoothly. It gets you ingrained with the different markets in the Twin Cities, so we're very familiar with kind of what makes sense for what markets. And we know who the builders are, we know who the subcontractors are, we kind of know a lot of those things. So it's gotten us very comfortable with facilitating the construction process, whereas some other banks who maybe just kind of dabble in it, the process can go a little more clunky for them, and the builder feels that and the consumer feels that, and it's not as great of an experience. Whereas because we do this so often and so regularly, we are just much more efficient at it, and it becomes where not only the consumer but the builder really enjoy working with Tradition from that standpoint. And sometimes it gets to the point where they just say, hey, if we're going to do a deal, we got to work with this bank, because we just know that, hey, we're going to get our money, the house is going to get built in an appropriate manner. And then just all the parties are aligned on things then too.
And how does Tradition Mortgage work in with Tradition Capital Bank? Because obviously, as Joe said, there's a lot of experience there, but there's a lot of connectivity between the two, and has it become almost seamless? Is that how you would describe it?
Yeah, absolutely. We're really a tag team. Is how we operate. Tradition Mortgage, I call us kind of the point of sale experts. So we're out there talking to clients on the front end, doing kind of the feasibility discussions and doing the kind of loan pre-qualification, running the payments. So we do kind of that analysis on the front end and make sure that ultimately they can afford the long-term mortgage, not just the construction loan piece, but that long-term mortgage. So there's a lot of discussion there. The construction loan is kind of a means to an end. They want to get the home built, but ultimately they want to know, what is my monthly mortgage expense? And that's where we can talk to them about what products are available, because ultimately we're providing that end loan product. So we do that upfront vetting. We bring it over to the bank. The bank will kind of match that borrower up with their underwriting program and their credit committee, issue an approval. And once we close on that construction loan, it's assigned over to the bank. They'll administer the draws, work with the builder, make sure that the home gets built, make sure that everything is very seamless. And again, once the property's completed, Tradition Mortgage kind of steps back in and places that end mortgage for the customer, which is your 30-year fixed rate mortgage or your 15-year fixed rate. So really, we're the customer doesn't really see anything different, but we're kind of working back and forth as a team, as a tag team, as I would describe it. So we're both experts in what we do. So we're all along the way, the client is backed up by people that really know what they're doing, as compared to, like Joe was talking about, maybe a bank that doesn't do construction lending as much, or maybe a bank that doesn't do as much as far as end mortgage options. So we give the best of all worlds, and it just really creates a nice seamless product for the client.
Yeah, and I think just to dovetail a little bit on what Erik is saying, a lot of people, it's their one and only time they're going to build a house. Mm-hmm. So just kind of educating and setting expectations on the front end with, okay, here's how the process goes, here's the timing of things. And between Erik and his team and the bank's team, because we work so well together and because we've done so many of these loans, we know what to lay out as far as what to expect, and here's the timing of things, and here's where, here's when the appraisal's coming, here's when the bank's going to step in, here's when we'll engage you for the end loan. Mm-hmm. So the customer knows going in what that process is going to look like then too.
Everyone is facing that same question. How have things changed in your industry? And Erik outlined a lot of those things for mortgage. How has that been for the banking industry and more specifically new construction loans? Because I know there are certain details like materials that have gone up quite considerably. So how have things changed as an overview here for what you do and how the new construction operates?
Yeah, I think that there has been some of those changes where the material costs have gone up. Lumber is a big thing that has gone up quite a bit over the last even just few months. Yeah. It continues to rise. Finding good workers and subcontractors to build to make sure the process is going in an efficient, timely manner has been a challenge. Some of those increases have been offset by the decline in rates. Right. So the consumer is kind of having a little bit more cost on the material side, but then as the cost of borrowing has gone down, some of that offsets a little bit from that standpoint where you look at the overall cost. It's mitigated a little bit by that. So it's been a good time. And then I think the other thing that's changed a little bit is just in working with Erik's team is, we've been able to design some products that, hey, with rates being low, allow people to get a construction loan, but then, how do you lock in that end loan earlier in the process so that allows you to take advantage of where rates are now. So we've had to be a little innovative on some of those things just because it's kind of a unique time from a financing standpoint then too.
So as things change, and we've talked about it, the markets are changing all the time, and sometimes they're changing in ways that we could never have predicted. So here's each of your opportunity to maybe look a little bit into the future for mortgage and banking and new construction loans, and maybe how they interrelate with each other a little bit. What do you guys see happening here going down the road? I mean, is it like it has been where you're sitting there and you're asking yourself, well, let's wait and see what this happens, or wait and see what happens there. How is it gonna affect the consumer? So if I walk in now or 6 months from now, what do you think the difference will be for people based on what you guys do? Sure.
Well, I can speak in the mortgage world. The question of the day always is where are rates going? And I would say that this big pop we've seen, like, why is that happening? And I think it really what drives mortgage rates is the bond market, and what drives the bond market is kind of future expectations of inflation. And you have some factors here where the economies are reopening again, the COVID restrictions are being reduced, you have vaccinations going up, so you're seeing that consumer spending is growing, and you see that employment is going up. So all these factors then put pressure on inflation, and then with the significant COVID relief bill that is imminently going to be passed here, it looks like that's a lot of bond supply going into the markets, and when you're flooding the markets with supply, rates go up, yields go up. They have to entice people to continue to invest, and if big capital investors can invest in stock market and get higher returns, well, the bond market's going to have to offer something up. So that's why we've seen this surge. But if you listen to the Federal Reserve speak, they're saying that part of that's to be expected. It's kind of like holding water back in a dam. You let it go. There's going to be an initial surge, and then it should level out as things normalize. So what we're hoping, as we go 2, 3, 4 months out, that hopefully it levels off, and long-term inflation, those indicators kind of come back down a little bit. So, my hope and my thought would be, yes, we're 50 plus basis points off the floor of where we were, but I think we're probably going to hopefully see, maybe a 10 to 20 basis point kind of range that we can travel in here through the summer. And again, that's going to still keep the door open for people that do want to refinance, that are maybe sitting on a higher rate or want to do a cash out or a home improvement. But certainly continues to be extremely attractive interest rates for people looking to build or buy.
And Joe, and again, looking forward, what do you see going forward? Maybe a little bit of predicting on how things will operate so that you can adjust quickly to how they work.
Yeah, I mean, I concur with everything Erik said. I don't see a whole lot of downward pressure in rates, that's for sure. I mean, I'm in the thrux of it right now as far as trying to build a home myself. So I can speak to it almost from the consumer side a little bit more than too. And it just seems like, hey, moving sooner rather than later on things makes sense to me, just in the where I see rates going. We talked a little bit about material costs. I don't see the inventory side improving. I don't see a lot of homes going on the market to sell all that fast either. So I don't think if people are looking to move that all of a sudden there's going to be this, abundance of inventory of existing homes to purchase. So I think the trends we've been talking about will just continue. I think from that standpoint, labor and material costs will probably continue to be a challenge. They can only go up so much, I think, then too, before before they level off, just because otherwise affordability can be a challenge for people. But I think that's what I kind of see. I see it's going to continue to be a good opportunity to borrow, and it's only as that forecast gets longer and longer, I only see that changing a little bit. So I think the best time is the present on that type of thing. And then I think the same thing on the housing side of things, as far as we're going to continue to have a tough time with finding inventory, and so that new construction route can continue to be a good option for people as they look at, hey, how am I going to upgrade or move into a new house? That's going to continue to be an attractive option.
So in your respective fields, do you think there's going to be that tendency to kind of rush in, right now, just because people, for the first time in a while, kind of seen things bump upwards? People get a little bit nervous. They want to kind of get in under the wire, so to speak. Do you think we're going to see that kind of bump here? Are we seeing it right now?
Yeah, well, it's always get a little spook in the fence, the people sitting on the fence, where there's a lot of people that were like, hey, what's the sense of urgency to refinance or do certain things? I'm going to have plenty of time. And then all of a sudden they see the bus leaving the station, the train leaving the station, and they're like, hey, wait for me. So you get that surge. Yep. And then, but once those rates hit a certain point, because again, the vast majority of the mortgages out there are already in a pretty low interest rate to begin with. So that will dissipate, and I think that will free up, origination capacity to focus on the purchase money market, what limited amounts there are. But again, lenders are going to be fighting over a smaller pool of potential deals out there. So margins, I on our side, bad news for us as a mortgage company, good news for the consumer. There's going to be some margin compression there that'll offset a little bit of the rising rates. So, and just, mortgage nerd in the weeds things, like Fannie Mae imposed a refinance fee internally on loans that go in, but that doesn't apply to purchase loans. So there is a little bit of a difference between a purchase money mortgage rate and a refinance rate. And again, with margin compression and lenders fighting over fewer deals, again, I think that'll offset a little bit of the rise in rates. But again, I think, there are kind of alarm bells that went off and woke people up a little bit, so people are kind of getting after it right now.
Yeah, I think the same thing on the construction, even the banking financing side. I think there's been a lot of liquidity that's come into the banking market in the last 12 months that, even though bond rates may rise a little bit, it seems like I think bank rates will stay compressed for a period of time here, just because banks do have so much liquidity and they want to put it out to lend, because that's where they make their margin, is lending it in loans and not having it sitting at the bank. So I do think that'll keep rates suppressed a little bit more than you would typically see if liquidity was a little bit less in the marketplace. So I do think it'll still, it's all perspective too. When the market was at 2.5, 2.8 for a mortgage rate for a while, and then it goes up to 3. People think, oh, rates are on the rise. That's still a pretty historically good rate, right? Yeah.
Well, it certainly sounds like you guys will be plenty busy going forward here. Erik, thank you again for joining us. Joe, thank you for coming in and lending us your expertise, especially on new construction loans. And we'll do this again every week, and we'll have a new guest every week. So we thank you both for joining us.
Thanks, Mike. I appreciate it. Thanks, Mike.